Welcome to Fundamentally Speaking. I'm Sarah Borgeson-Keeter with REIT.com. I'm here with Calvin Schnure, NAREIT Vice President for Research and Industry Information. Welcome, Calvin.
Thank you.
If you could give us an overview of how the commercial property sector fared in the first quarter?
Sure. The first quarter this year looked pretty similar to a lot of the trends that we saw last year. If you look in the apartment sector, we saw another tick down in vacancy rates to a new low for the cycle. Office sector also saw some improvement in vacancy rates, although the vacancy rates are still several percentage points above what would be normal in a healthy market. The retail sector, it's kind of like it was last year. It's sluggish. Vacancy rates were flat. We saw some deceleration in rent growth. So you're not seeing a lot of oomph in the retail sector yet. But it'd be wrong to look at just these superficial trends, because particularly in the apartment and office sector, we're seeing some developments that really bode well for the future. The vacancy rates moved down despite there being new supply coming on, particularly in the apartment sector. The two worries that analysts have had for apartments are, one, that the new supply would swamp the new demand, and we're not seeing that so far. And the second is that as the housing market improves, the move-outs are going to open up vacancies. We are seeing moderate improvement in the housing market, but so far there are so many people who are doubled up in shared living. They're roommates, they're with their parents, that are ready to move back in. So there's a lot of pent-up demand that's offsetting the people who move out to the housing market. Similar thing with the apartment. We're seeing, with the office sector, we're seeing increased supply. Construction is coming along, but the job market's improving as well. So we're seeing a good balance between the fundamentals of the supply and the demand in those sectors.
And looking at the broader economy, we saw GDP stumble somewhat in the first quarter. How much was that weather related, or was it a familiar case of the economy hesitating once it's just getting some steam ahead of it?
People have been scratching their heads to figure out just how much of this was weather related. And if we hadn't had this experience for the past 2 to 3 years of just as the economy gets going, the bottom doesn't fall out, but you lose steam again, I think people would have been willing to dismiss this as, we know that the weather was quite bad. Looking at the details of what's gone on with consumer spending in particular, the monthly pattern really leans in favor of saying this was mostly weather. January spending was very weak, February spending was very weak, and then March had a big acceleration just as the warm weather was coming along. We've seen other more recent data that are consistent with this just being a temporary phenomenon. A lot of economists are writing down numbers of 3% or so for the rest of the year for GDP growth. So 3% GDP growth, if they're right, would be good enough to do quite a bit for the property sector.
So Calvin, we're several years into this economic recovery. Taking a step back, where do you see us in the broader picture?
We are several years into this recovery, but the first couple years hardly count. The 2009-2010 growth in the macroeconomy and the improvements in the commercial real estate sector were so weak that it really doesn't count in the calendar sense of 2009, 10, 11, 12, 13, 14. We're not really 5 years in a conventional sense. Probably a better way to look at it is how much economic slack is there. That's what the Federal Reserve is looking at for their monetary policy, for their gauging how much more the economy can grow. Chairman Yellen has made it quite clear that she sees a lot of excess slack. She sees the main risks that the economy has to get back up to speed. Her risk on the inflation front is they want to get inflation back up to 2% so we don't face risks of deflation like Japan had faced. That means that the Fed wants to see the economy growing above trend, above the 2.5% to 3%, which is a normal trend growth. And it takes some time for the economy to get there, bring all of the unemployed workers, the people who are on the sidelines in the job market, back into the job market. Altogether, this process is going to take quite a bit of time. We could face several years of GDP growth of 3% or more, which is actually a very favorable outlook for commercial real estate. The commercial real estate sector itself, we talked earlier about the vacancy rates. Apartment is just a special case. It's already very low. The office sector has a lot of slack to absorb as well. So we could see very robust job growth. And the new construction coming along is going to meet some of that additional job growth as well.
Well, thank you very much, Calvin.
Thank you.
And for more news and analysis on all things REIT, please visit REIT.com.